Hi, Shell Point. I'm Jeff Corey from the Legacy Foundation, joined today by Michelle Hoover. Michelle, thanks for being with us today.
Thank you for having me.
Great. Michelle's a CPA here in town, and she always does a year-end tax planning seminar for Shell Point residents. What you need to know as you look for planning your income tax. So we're just going to have a little conversation today, Michelle. I know there was some major tax law changes here, last for 2018, and I assume some of those carrying over for this year. Anything big our residents should know about as they look at planning for this tax year?
Well, for 2019, the biggest change for Shell Point residents is going to be the, as far as medical expenses go, is the adjusted gross income limitation has risen from 7.5% to 10% of adjusted gross income. So you just have a little bit more, you've got to get over a hump to be able to take advantage of itemizing your medical expenses.
Okay, so once you reach 10% of adjusted gross income, then you can start writing off.
Then everything above 10%, you can write off those deductions.
Okay.
And if you've got enough of other deductions, then you can itemize. So.
Okay. Have you seen a change in, I know the exemption amounts were raised here. Have you seen a change, or are there more Shell Point residents, that are able to itemize or less?
It was probably in about 80% of my clients that are here are still able to itemize.
Okay.
But with the higher standard deduction, the medical deduction that they get from their maintenance fees allows them to puts them over the standard deduction limits. So it depends on every tax, every situation's different.
Right.
But for the majority, they were still able to itemize.
Okay. And you brought up the medical deduction. So just as a reminder to our new residents, if they closed here during 2019, they're able to take a good portion of that towards a medical deduction.
Correct. Yeah, and they want to make sure that they do tax planning now before December 31st.
Okay.
Because this is a very big medical deduction that you'll have one time. It's usually anywhere between 36 to 39% of the entrance fee that you paid if you have a standard A contract.
Sure.
And it's a deduction you lose if you don't do any planning. So you want to, if anybody approaches you, just let them know to see their tax advisor sooner rather than later.
And one of the things they can do in planning is maybe look at some retirement plans or maybe bringing some income forward in this tax year, right?
Yeah, typically we'll look at what types of income that they have. Usually if they have some kind of qualified IRA, then we would try to take more income into the current year because they have the big medical deduction, maybe roll that into a Roth IRA so it can grow tax-free. Sure. And then you don't have required minimum distributions on the Roth IRA.
Okay. So what are some of the things, typically you would see, residents should consider here in the final few months of the year, as far as their tax planning? One of the things, we have lots of residents that maybe gift to a family member or a child. Mm-hmm. What's the amount that they can gift now?
This year, it rose in 2018 to $15,000. Okay. So you can gift to any individual for $15,000 or at $15,000. You just want to look at husband and wife can each gift $15,000 to the same individual, so that there's different options for doing yours, and it comes in handy with estate planning as well.
Right. Okay. So just to be clear, it's $15,000. Anything over that, they've got to file a gift tax return.
Just file a gift tax return.
They don't pay any extra tax.
They don't pay tax.
Right.
They don't pay tax, and the individual that you're giving the gift to does not pay tax at all.
Okay. So what are some other things maybe some residents can look at as far as minimizing income tax? Are there some things that you might suggest?
Well, depending on their situation, we talk about maybe contributing, doing a qualified charitable distribution from their IRA. That's one way of planning. Also, I work with a lot of the financial advisors, and if I've got a client that has some appreciated stock, we look at taking maybe gifting to the charity appreciated stock versus selling it at a gain.
Right.
So and I'm going to talk about that when I give my presentation. I'll go into more detail about that. Yeah. One thing that the other thing I'm going to talk about is some people think that there's ways of gifting to family members that wouldn't affect won't affect the 15,000 annual exclusion. So there's certain types of expenses that you can pay on behalf of a family member, and it would not be considered a gift.
Right. Okay. Now we do have some residents, new residents that have moved from out of state, come here from some other beautiful state, moving to Florida. We don't have an income tax here in Florida, right?
Correct.
Okay. What else should someone know that's coming from out of state? Maybe just move to Shell Point.
Typically, we will, when I work with new residents that come in, we'll file that final tax return. That's usually a happy.
Okay.
That's usually a happy.
Occasion.
Filing that final state tax return. We don't have, since we don't have a state income tax that does limit the itemized deductions. If you were paying state income tax in your old, where you used to live, you were able to deduct that.
Right.
You won't have that deduction any longer.
Yeah.
So as far as planning for 2019, people can look at, you basically want to look at if you were not able to itemize last year, you may want to consider paying expenses early in 2019.
Okay.
We call that bunching expenses.
Right.
So if you'd like to give donations and you want to be able to take advantage of that charitable deduction, maybe bunching and paying more of the amount, give more in 2019,
right,
and then skip out 2020, and then give more in 2021. So we call that bunching.
Yeah.
Bunching your deductions.
Makes sense. Now you brought up the idea of working with a client's financial advisor. I know you do a lot of that.
Yeah.
I don't hear that often, times that, I got to talk to my CPA and my financial advisor. You encourage people to do that, I would assume?
Oh, definitely.
It can make a difference.
Your CPA should be talking to your financial advisor, vice versa. Anytime that you're making any decisions on selling positions, it's just always good that we be able to run a tax projection. Because I always tell my clients, we don't want to make decisions, financial decisions, your investment decisions, solely based on tax.
Right.
But it's better to be prepared for it, so there's no surprises.
Sure. Great. Well, Michelle, thank you for being here. We're looking forward to our Academy program, October 17th. Again, Shell Point residents, October 17th. The program is entitled Common Tax Questions from Shell Point Residents. Michelle will be here. Bring along your questions. October 17th, the Grand Cypress Room at 10 a.m., and we'll look forward to seeing you then.